With the escalation of the conflict in Ukraine, markets continue to see trades go off risk. But what is being priced in? And so far as the local markets are concerned, are UK politicians right to attribute what's happening here in the gilt markets and sterling to be rooted in what's going on in Ukraine? Well, welcome to this edition of IG Trade in the Markets podcast. I'm Jeremy Naylor. I'm joined now by Marc Ostwald, Chief Economist and Global Strategist at ADMISI. Marc, welcome. First, I'm interested in what you're hearing in terms of what's happening in Ukraine, and ask, with you spending a lot of your time in your native Poland, but also coming further west back here to the UK, if there's much difference in terms of interpretation of what's happening on the ground.
I think that there's always inevitably a good deal of difference in interpretation, simply from the point that even before the Russian invasion of Ukraine, Central and Eastern European, above all Baltic and the likes of Poland, politicians and people in general basically always said that the West never took the threat from Russia seriously enough, and they were constantly warning them. Then when it happened, they said, "We told you so." But you've been spending so much time cozying up to Russia for your own, what one might call mercantilist purposes, particularly in Germany. It's cheap energy, and you didn't actually realize what the real threat was. So the interpretation of any event subsequently is always going to be somewhat different. I think we have moved on in terms of Central and Eastern European views of developments, but inevitably now, with Russia suffering a good many setbacks, and Ukraine taking back some of the ground, what is now happening in terms of what one might call a more Syrian approach by the Russian military forces of bombing large parts, sending missiles parts over to large parts of Ukraine, looks like it takes us into a different area, particularly with the threat of nuclear weapons being deployed, whatever description one may want to apply to it. I think tactical to me always sounds a little bit like, it sounds like, oh, well, if it's only tactical, it's all right. Well, it's not. We all know that. But there does seem to be, we seem to be at some form of, I wouldn't say necessarily end game, but we're certainly changing how this starts to play out. We're coming into winter, which is very important because during the winter, well, for the first part of the winter, everything is basically unnavigable. So for heavy military equipment to be moved around, it's almost impossible because the ground's too wet. Then it ices over, and then you can move again. So we're left with this situation of what is Mr. Putin capable of doing? And I think the point lesson since 2014 is the answer is anything, and that's what we have to prepare ourselves for and hope that it won't happen.
Okay, so onto the markets. To what degree do you think all this risk off that we're getting at the moment is based in the conflict between Ukraine and Russia, and how much of it is of our own making? I'm thinking about what's happening here in the UK, because successive governments have taken a lot of tax income out of the balance sheet so far as the UK is concerned, driving taxes down. We've got enormous amounts of debts now, and we now have this problem of funding, and there's a bit of a squeeze going on here in the UK. How much of what we're seeing on the ground in Ukraine is responsible for that? Because if you ask politicians, they say, well, yeah, that's where it's rooted. Do you agree with that, or do you think it is more clearly rooted in what's been happening here in the UK?
I'll borrow something which was a quote from one of the Polish central bank governors this morning, who basically said that to blame the rise in inflation, this is obviously in Poland, but everywhere in Europe has an inflation problem. Poland's perhaps slightly worse than the UK, but that's a little bit much of a muchness. And he said basically to blame the inflation that we've got on the conflict in the Ukraine is absurd, and I would tend to agree with that. It is, I would call the Russia-Ukraine conflict something which exacerbates what were already deep-rooted problems. We have deficient energy structures, but both in the UK and in continental Europe. That has been evidenced for quite some time, and to change those, quote some people I was speaking on at a panel at Energy Trading Week the week before last. It may take a generation actually to sort out a lot of the energy problems. We can get over the worst of it, but those energy problems are at the root of all the inflation problems that we have. Disruption to agriculture is in part also tied to that, as we know. A lot of fertilizers are a natural byproduct of gas, and if gas prices are up in the sky, then a lot of the manufacturers or processing plants just are no longer commercially viable. So those sort of problems aren't going to go away. And indeed, I think the general consensus view that I've seen from most people in both the agricultural and the energy sector suggests that if we think this year was bad for energy and bad in terms of disruption to agriculture, next year will probably be a lot worse. From the energy sector, very simply, yes, Europe and the UK had the opportunity to build up gas reserves while the flows were still coming from Russia. Now they're no longer coming. That will be a problem next year. As for the UK specifically, well, I think one of the long traditional things in the UK is always to find a scapegoat on the international stage for some of the UK's woes. It's a long-standing tradition. It's not actually party political, i.e., it doesn't really matter who's in power. The blame will always be laid at the door of France, Germany, the EU, Russia, the United States. It doesn't matter. It's always someone else's responsibility and not the decisions taken by successive governments. Again, this is not party political, so I would stress that it's no different whether we have a Conservative or a Labour government. What the UK definitely has it's had an overly long reliance on imports, which in an age of plenty is fine because you can trade your way through that, and the UK's rich history of trading with the rest of the world certainly lent itself. In an age which is no longer the age of plenty, as we have now, where there is always competition for raw materials, for intermediate goods, for finished goods, that becomes a serious problem. Particularly, the UK's infrastructure in terms of transport is not good. It's made great efforts to obviously move towards renewables, but it's gone down the wind route like most of Europe, and wind is simply unreliable. And therefore, you're always basically firefighting in that sort of situation unless you have very stable prices for the broad energy, well, hydrocarbon energy complex. So those problems are simply not going to go away. And with what one would call the Trussonomics, if one wants to call it, which is good in principle in terms of the idea of trying to stimulate growth and productivity in the UK, it's a great idea. But if you actually can't detail anything, and particularly having put an infrastructure in place for UK governments to have things vetted by the Office of Budget Responsibility, OBR, and not using it, and then basically randomly coming out with, saying, well, we're going to spend this, that, and the other, and people actually wondering, well, how are you actually going to fund it? Because the fact of the matter is the world has been building up debt for a very, very long time. The 2010-2019 period, just as an example, and this is a ballpark for all major economies, but basically for every $2.50 of debt that we created, we got $1 of GDP. So debt has been growing alarmingly, and now, obviously with COVID, it grew alarmingly more. And so that is a problem now for the UK, which really wants to try and spend its way out of trouble without providing sufficient details.
As someone that sees the big picture, Mark, what do you make of what's happening in terms of fiscal and monetary policy? Because you've got the Chancellor on the one hand cutting taxes, making trying to make the economy work by making money a lot easier, and then you've got the Bank of England raising interest rates, which has absolutely the polar opposite effect. Do the two not talk? Is this unusual in your mind? I mean, do you see that all ending in tears? Where do we go when you get two arms of control doing the opposite thing?
Well, I recall a comment by the late Bank of England governor, well, not late, he's still alive, by Bank of England Governor Mervyn King at the time of the global financial crisis. in which he said he thought that the major bank CEOs in the UK had more of an ear from the Treasury than he did. And I think, unfortunately, what we've got a situation is at a time where monetary and fiscal policy need to be closely aligned and strategically deployed in a sensible way. It's not actually wrong at the moment to have tight monetary policy and loose fiscal policy, but not when there is this underlying sense that there is no coordination. In fact, there seems to be, well, if anything goes wrong with all of this, it'll all be the Bank of England's fault. That is not an operating principle that is acceptable. And indeed, when one looks around the world, it's true in many countries, but in the UK, it happens to be particularly acute.
Do you think the UK is in, I don't want to use the word crash situation, but do you think we are in a financial crisis?
I think we certainly are. And, a lot of chickens are coming home to roost in terms of the pensions industry. A lot of the liability driven investing that's been going on, basically in principle, the idea is to ensure that pensions have enough assets to match their long-term liabilities. But what we've found is that old devil leverage has been deployed to try and do this. And now we find ourselves, as Andy Haldane wrote in an article in 2014 called Halfway Up the Stairs, he basically said what we've done in terms of the financial system that we have, and it's particularly acute in terms of the pension funds, is we've taken all the risk out of the bank balance sheets and put it into the fund sector, above all the pension fund sector. And when you get the sort of volatility that we've got, and I would stress to people, 360 basis point round trip in terms of the yield since September the 16th in the gilt, the long 30-year gilt,
Yeah.
means basically that's volatility that no one can hedge against. So
Yeah.
that creates a crisis point.
Andy Haldane, of course, the former chief economist at the Bank of England. What do you see as the solution? Is there a solution? Is there a way that the government could head this off, even though we are possibly already in a sort of crisis of sorts? Is there a way to try and mitigate the effects of all this?
Well, the Bank of England firefighting isn't the solution. There will have to be some backtracking by the government. We've already seen some in terms of cutting the top rate of income tax, but that is marginal when you consider that the Institute for Fiscal Studies says basically there's about a 64 billion shortfall. And we're also in the middle of a cost of living crisis in the UK, as we are across most countries in the world. So they need basically to come up with something which is far more credible in the long run in terms of how are you going to balance out the extra spending to try and boost the economy against what your other outlays are, and how are you going to actually improve your revenues? Because going down the route of we'll grow our way out of it is, yes, many people have said that. It's a hope and a prayer. It's not a plan.
Yeah. Current trade of sterling is just over the 110 level, sterling against the US dollar. Do you see the 103.50 area being hit again? That was the low point we had in the immediate aftermath of what has now been described as a disastrous mini budget we had from Kwasi Kwarteng just a couple of weeks ago. Do you think the direction of travel is more likely weaker sterling against the dollar? Of course, the dollar's got a life of its own, so one would imagine that perhaps maybe a trade to follow. But what are your thoughts on sterling and where we go from here? Because at the moment, it's importing a lot of inflation, as you say.
It is importing a lot of inflation. I think the real key here is how the economy actually starts. What indications we have on the economy going into Q4. That's going to be inevitably important. What we get in terms of the actual budget at the end of October. Sadly, that's a very long time to wait. I would also stress it's not good. It creates vulnerabilities for sterling. The moment anyone says anything that suggests they don't really have a plan. So the vulnerability on sterling, against the dollar, one might partly blame it on the just general strength of the dollar and the Fed's wholesale commitment, even if there's seems to be some chinks to getting inflation under control. But in terms of more broadly against the euro, for instance, the weakness is really down to UK policy versus the way UK policy is being framed or unframed, I should say, the lack of detail, the lack of a plan, there's lack of anything that anyone can really get hold of. So the markets will now judge UK quite harshly, and that's why that vulnerability on the downside is inevitably there. And the Bank of England has the most unenviable task I can think of in the world, because the UK economy is just as weak as the Eurozone economy, if not weaker. I think actually we're arguing the details on which is weaker is really largely irrelevant. They're both weak. That's that fact of the matter. And if the Bank of England is going to really hike rates aggressively to try and get inflation under control, things are only going to get worse, and the numbers in terms of government finances then start to look worse as well.
Inflation, largely about what you've been saying, is actually out of the UK or Bank of England's control, surely, isn't it? Are you seeing any evidence of second round effects that the Bank of England does have control over?
Well, there are inevitably second round effects, and a lot of it actually has to do with the fact that the labour market isn't going to loosen. In fact, what
Right.
we're seeing from the latest labour data is that there are more and more people becoming inactive. Now, some of that is baby boomers retiring. Some of it is the fact that actually the health system in the UK is one which is not preventative and always reactive, and therefore a lot of people who could be in the workforce are being prevented from rejoining the workforce by long-term illness. And that creates a lot of pressure on wages, particularly if we don't loosen some of the laws which have been introduced since Brexit on migrant workers.
Mm. Look, sorry, very quickly, we're almost run out of time. We've been talking a lot about the UK. As I said earlier, you're a big picture man. Is there anywhere in the world that's, I wouldn't say insulated from what's going on, but are there areas of the world where you see perhaps possibly maybe we should be looking for investments, longer term investments, rather than the UK?
Well, I think there's two areas. Asia inevitably is always going to be the area which the world's economy is pivoting to. It's partly due to population. It's partly due to the fact they are more adaptive. They are that much quicker to react. They have less ponderous infrastructure which needs updating, which hasn't been updating, and they're less, in a certain sense, less financialized. The other one was where I was last week, which was down in the Arabian Gulf. We know, and I'm sure that the latent next set of IMF forecasts, that Saudi Arabia is going to be the strongest economy in the world. No one predicted that at the beginning of the year. And indeed, when one's looking at the whole UAE, Bahrain, Qatar, Kuwait, Oman, all of those areas basically are absolutely in the right point to capitalize on what we have as an energy infrastructure for the time being. We may be transitioning, but in the long run, even those economies are already transitioning. So they're going to capitalize on both sides of the equation, both the boom in the demand for hydrocarbons and the boom in renewables. So those are the two areas which I think are definitely, and one should also stress in terms of the GCC, it's not just about hydrocarbons. It is a booming area. They're non-aligned. They are basically standing back. They're not going to pick sides between China and Russia on one side and NATO on the other side. They will merely capitalize on the opportunities that they have, and there is plenty of demand for what they've got.
Interesting. Okay, look, Mark, we'll have to leave it there, but thanks indeed for joining us. That's Marc Ostwald, Chief Economist and Global Strategist at ADMISI, in today's IG Trading the Markets podcast. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.